for ethics topic. Let's go. Hello, my name is Shen Hao, and I'll be talking about my topic, which is misrepresentation on financial statements. It refers to the act of providing false, misleading, or incomplete information in a company's financial reports. These misrepresentations can be intentional, such as fraudulent, or unintentional, such as errors, and can distort the true financial position or performance of the company. So let's talk about the examples of misrepresentation. For number one, it's FTX. It's a company that is engaging in hiding the customers' funds to the sister company, Alameda Research, to cover risky investments. The company also has their own crypto coin named FTT token, in which they artificially inflate its prices to make it seem like they're doing better than they actually are. As for number two, the newer brands, they are known for creating products such as Sharpie. They engage in channel stuffing, which is when they ship more inventory to the retailers to inflate their sales. The executives also pressured retailers to take in more inventory than they need. Through this, we can understand the specific violations of the IFAC code due to misrepresentation, which is number one, fraud and deception. They providing false financial statements, records of reports to stakeholders violates the principle of integrity and professional behavior. Number two, financial reporting. Misleading investors, creditors, or the public by misrepresenting financial data or by failing to disclose material information can lead to violations of accounting and auditing standards and regulatory requirements. Number three, conflict of interest. Pressure from management or personal gain can lead auditors or accountants to compromise their independence. Now let's talk about the prevention. Number one is stronger regulators. Governments and regulators must enforce strict financial reporting standards and impose penalties for non-compliance. This ensures that companies are held accountable for honest reporting. Number two, internal control. Robust internal controls such as thorough auditing and transparent reporting processes can help detect discrepancies early and prevent misrepresentation from occurring in the first place. Number three, ethical leadership. Ethical leadership within a company plays a critical role in fostering a culture of honesty and integrity. Where leaders prioritize ethics, it sets the standard for employees, reducing the temptation to manipulate financial statements. Number four, whistleblower protection. Companies should protect and reward employees who report such unethical behavior. And so, in conclusion, misrepresentation harms trust, stakeholders, and the broader economy. To restore confidence in financial reporting, companies must prioritize transparency, ethical leadership, and strong internal controls. Thank you.
Hello, I'm Lotichin. The topic I will talk is the ethic in accounting professions. So what is ethic? Ethic is a branch of philosophy that studies the difference between the right and wrong. A professional required adhere to the code of ethic conduct like integrity and objectivity because the member of public might place their trust in you. It revolves around making principal choices, upholding the transparency, and showcasing a commitment to maintain the integrity. Code of ethics has set by the different institutes like IEASP, FESP, and professions must be the honest, truthful, and transparent in all their professional dealing. For objectives, they must be making professional judgment without being influenced by the personal interest and external pressure. Profession competence should have the necessary knowledge, skill, expertise to perform their duties competently. In confidentiality, professionals make sure the privacy and security of sensitive financial information. Professional behavior accountants should conduct themselves in a manner that protect the dignities and reputation of the professions. So different code of the ethic in financial must treat everyone with respect and consider the impact of their decisions on all parties involved. First, in tax area, should consider the society impact of their actions, supporting the public goods and upholding the integrity of the tax system. So next is the importance of ethics. The accounting professions form the backbone of the economy and maintain the financial stability and fostering growth. It functions as a custodian of economic health and sustainability. This ethical standard guide accountants in their daily operations and shaping their professional decision and behavior. Next is the scandal of PwC. PwC Junior shared the answer by providing and receiving the answer to tests for mandatory internal training courses that cover the topics such as auditing, accounting, and professional independence. The shared drive and contain the answer for at least 46 of the PwC roughly 55 mandatory assurance tests. So next is the challenge. Challenge that may face the manager give pressure like one accountant to make the financial statement to look better. And another one is the professional has to refresh their knowledge because the standard frequently change, and also have to make the professional judgment without influenced by the personal interest. Okay, last is the ethic will build the professional environment and culture, contribute to a stable financial environment conducive to sustain growth and prosperity. In conclusion, ethics is a foundation of the accounting professions, guiding the professional to make the responsible decision and build trust, which support the economy's sustainability and growth. Thank you.
Hello everyone, I am Rosita and today we are discussing the controversial issue of insider trading, an important topic in the financial world. First of all, what is insider trading? Insider trading occurs when someone with access to non-public information about a company uses that knowledge to trade its stock or securities for profit. For example, if an employee learns about an upcoming merger and buys or sells stocks based on that secret information, that is insider trading. Ethically, insider trading undermines fairness and transparency in financial markets. Trust is vital for markets to function, and when insiders use secret knowledge to profit, it creates an uneven playing field. This damages public trust, potentially driving investors away and harming economic growth. Now, let's move on to the real case example. A famous example is Martha Stewart, convicted for selling shares based on the tip-off about a stock drop. More recently, which is in 2022, the case of Matthew Panuwat brought attention to shadow trading, where confidential information about one company is used to trade in an article in an unrelated company, raising new legal and ethical concerns. Legally, insider trading is prohibited in many countries with strict penalties. In the US, the SEC enforces laws like the Securities Exchange Act of 1934. However, as markets become more complex, are these laws enough? Shadow trading, as seen in the Panuat case, challenges traditional boundaries of insider trading. So, how we can improve ethical practices and prevent insider trading? Here are few recommendations to improve ethical practices. We need stricter enforcement of insider trading laws, clearer compliance policies, and education on ethical obligations, especially in today's digital age. So, in conclusion, insider trading continues to be a major issue, but with proper regulation and accountability, the finance industry can maintain trust and fairness. It is up to both regulators and professionals to ensure a level playing field for everyone. So, what are your thoughts on insider trading and shadow trading?
Hi, my name is Muhammad Ahmad Daniel, and now I will talk about sin stock in accounting. So sin stock are shares in companies that are involved in controversial industries like tobacco, alcohol, and gambling. So these industries are often criticized for their ethical implication, but are known for their financial stability, despite their controversial nature. Sin stock are often attractive to some investors because it gives a stable demand, which is product like alcohol, tobacco, and gambling tends to have a relative inelastic demand, meaning they are less affected by the economic downturns. Secondly, it is high profitability, which is since industry often have high profit margins and generate significant cash flow. And thirdly, it offers high dividend. So one of the example of mine, I have a graph here. So in the 2009 and 2024, so I highlighted both this year because it occurs economic downturns. But this company managed to increase their share price. And what is the sin stock accounted for? So firstly, for the investment classification, if held for short-term gains, it is recognized as trading portfolio, while if held for long-term purpose, it will be recognized as strategic investment. And secondly, what is the revenue recognition and dividends? So dividends from sin stocks are recognized as income in the period received. And lastly, the disclosure requirement are public companies may disclose potential risks such as lawsuits in their financial statement. And what is the ethical concern about this? Is ethical concern about sin stock are very significant. So first of all, because it is harm to society, which is cause addiction, health problems, or other negative consequences. And the ESG consideration are, they have three, which is the rise of ESG investing, which is ESG funds exclude sin stock to align with ethical principle, and they rely on SASB principles. And secondly, the contrasting viewpoint, uh, some investors prioritize returns over ethical concerns, which is Warren Buffett holding invest in Coca-Cola despite their controversial argument. And lastly, it is cost reputational risk, which companies endorsing sin stocks may face public criticism. And in conclusion, sin stocks are controversial but financially robust investment, and because of ethical and ESG consideration, it will help to shape the investment decision. So thank you.
Hi, so I will be talking about AI in taxation planning. AI is changing the way we do tax planning. It can accommodate boring, repetitive tasks and help us to find smarter ways to save on taxes. It's becoming an important tool for businesses and accountants alike. So, what is taxation planning? Um, what does AI do in tax planning, and what AI uses technology like machine learning to analyze large amounts of financial data to quickly and accurately. For example, AI can check tax laws, find patterns in financial records, and even predict future tax bills. It can also accommodate tasks like reviewing invoices or making sure businesses follow tax rules, which saves time and reduces mistakes. For bigger companies, AI can handle more advanced tasks like figuring out the best way to pay taxes in different countries or spotting areas where they might be at risk of being audited. So how do we apply AI in our tax planning, and what are the benefits of it? So AI in tax planning has many benefits. For small businesses, it makes things simpler by helping with tax filing and ensuring that they follow the rules. For large companies, AI can do more. For example, it can look at global trade data to suggest cheaper and tax-friendly ways to move products. It can also help businesses comply with the international tax laws cited by KPMG, and examples such as the OECD rules on fair taxation. But the biggest advantage of AI is how it provides useful insights. It analyzes past data to help businesses make better decisions, reduce tax bills, and also stay ahead of risk. So now that we've done the benefits of it, what are the challenges of AI? Of course, AI isn't perfect. If it's trained with bad data, it can make mistakes or give wrong results, and because of it, it deals with sensitive financial information. Keeping the data safe is very important. AI is also not here to replace accountants. Instead, it helps them to focus on bigger tasks like planning and making smart decisions for businesses. So, in conclusion, AI is changing tax planning by making it faster, smarter, and more accurate. For us as future accountants, learning to work with AI will be just as important as understanding tax laws. Thank you.
So for my next topic is the cryptocurrency and blockchain. Cryptocurrency is a digital currency that alternative form of payment created using the encryption method. The use of encryption means that cryptocurrency is both of a currency and a virtual accounting system. So what is a blockchain? A blockchain is a decentralized distributed ledger. Blockchain blocks are made of the transaction and interaction forming a chain. Those blocks can record a variety of digital things like supply chain data, international payment, and personal information. So next is the blockchain used in accounting professions. First is the accurate and secure the record keeping. Every changes in blockchain must be approved through the consensus mechanism on a peer-to-peer network of computer. The record are protected from hacking and action by untrusted actor. So next is distributed ledger technology. The share of distributed ledger become easier to use with multiple players. The business in the entire supply chain of a particular good can access and provide a data to the share ledger. Smart contract. The use of smart contract like a self-executing contract where once all the conditions are met, payment, goods, or service are automatically released could make it easier to settle the bill. This could reduce the occurrence of late payment, unpaid invoice, and dispute. The next one is the benefit of blockchain. First is the cost-effective solution for accounting. It is possible to cut down the cost such as what is needed to reconcile of record and auditing. Then the second one is the decentralization, means the record remain consistent across the location and country. This ensures the professional has access the same information. So next is the increased privacy. Blockchain encrypt the data, use a system that prevent the data corruptions. Private key authorization is used to protect the data, so the network administrator only have access to an overview of the data and not the user-specific information. So next is the streamlined process. Blockchain technology can make it easier for the business to set up the transparency, efficient, and secure the business deal. So next is the challenge and risk. Crypto asset analysis can be difficult because the currency variations and change dramatically and over a short period of time. As a new industry, crypto and blockchain are not regulated, so you don't have as many legal protections as you would when using traditional payment method. Even though the blockchain are more secure and using debit or credit card, you still run a risk of being hacked or losing your cryptocurrency wallet. So in conclusion, cryptocurrency offer a secure, cost-effective solution for accounting, enhancing the transparency and privacy. Thank you.
Okay, hello everyone, it's me again. Now we are discussing a major topic reshaping the accounting and finance sector, which is job displacement in accounting and finance due to technology. With advancements like automation and AI, the sector is transforming rapidly. While technology promises efficiency, it also raises concerns about jobs traditionally performed by humans. Technology has always driven progress in accounting and finance, automating tasks like data entry and auditing. AI and tools like robotic process automation make processes faster and more accurate. However, this also displaces roles, especially repetitive tasks like data entry and basic reconciliations. But do not worry, there is more to the story. Technology is also creating new opportunities. So the big question is, will AI completely replace human accountants? The answer is not as simple as a yes or no. AI excels at automating tasks like data entry, preparing financial reports, and detecting fraud or anomalies. But AI lacks the human touch, such as judgment, creativity, and ethical decision making. Accountants add value through strategic planning, solving complex problems, and building client relationships. Instead of replacing accountants, AI enhances their work, allowing them to focus on higher value activities like advisory services. As the Video Audit Innovation Survey 2024 reports, 54% of finance leaders believe AI would not replace auditors but will let them focus on more strategic tasks. AI handles the data-heavy parts, but human auditors interpret the data and make decisions. Now let's look at the real-world example, which is Deloitte's integration of generative AI in auditing. Deloitte's approach has three phases. The first one is facilitator phase. AI organizes data for easier analysis. The next one is collaborator phase. Tools like Risk AI predict risk and assist with decision making. The third one is integrator phase. AI automates anomaly detection and evidence gathering. While these tools improve efficiency, they reduce roles focused on repetitive tasks like manual audits. Now let's move on to the challenges and opportunities. The challenges include job displacement for routine roles and skills gaps, as many professionals need to learn new technologies. However, opportunities are emerging, such as upskilling. Accountants can learn AI and data analytics to stay relevant. Next is strategic roles. Professionals can focus on advising clients and solving complex problems. Last but not least, new careers. Roles like AI auditors and data scientists are now in demand. So in conclusion, technology is transforming accounting and finance. Job displacements is real, but it's not the end for accountants. By adapting, upskilling, and embracing change, professionals can thrive in this new landscape. Technology is not just replacing jobs, it is reshaping the workforce.
Hi, I will continue my topic, which is AI in regulatory technology for investment compliance. So what is AI in RegTech for investment compliance? Firstly, AI is a system that mimics human intelligence for tasks like decision-making, pattern recognition, for example, like machine learning, natural language processing, which is called as NLP. RegTech is a technology designed to simplify and streamline compliance with regulation. So generally, it enhances compliance processes in investment management. So what is the challenges in investment compliance? Firstly, it is involving regulation across jurisdiction. And secondly, it is high cost of manual compliance effort. And thirdly, it is rising threats of fraud, insider trading, and anti-money laundering AML violation. And lastly, it is difficult in monitoring massive transaction volumes. So what is the application of AI in investment compliance? Regulatory monitoring and updates, which AI tracks global regulatory changes in real time. And secondly, transaction monitoring, which can detect of suspicious transaction using machine learning. And the risk management, which can predict analytic to flag potential risks in portfolios. So AML automation can identify verification and detecting illegal activities. So what is the benefit of AI in RegTech? Firstly, it is efficient, which automates repetitive tasks, reducing and workload. Secondly, it can minimize errors in compliance checks. And thirdly, it is cost saving, which can reduce operational costs over time. So what is the real world example? So we have two examples here, which is example one is a global asset management firms reduces AML review times by 80% with AI. And example two is an investment bank detects 40% fewer compliance breaches using AI powered transaction monitoring. So what is the future trends in AI and RegTech? So firstly, is a predictive regulation. AI system will increasingly forecast regulatory changes before they happen, enabling firms to prepare proactively rather than reactively. By analyzing historical trend and market data, AI can predict which sectors or activities might face new regulation. So lastly is a self-learning system. AI system powered by reinforcement learning will evolve dynamically as new regulation emerge, and it automatically adapt to a new compliance rule without extensive human intervention. And lastly, it can learn from past compliance scenarios to improve decision making over time. So in conclusion, AI is not just a tool for compliance, it's a strategic enabler that can turn regulatory challenges into opportunities for growth and innovation. An organization must embrace AI-driven compliance solutions to stay ahead of evolving regulation. Thank you.
Okay, that's all from us. Thank you for watching.
Bye.